are going to start today's roundtable with a conversation with Jukka Alanen, Senior Vice President of Strategy and Corporate Development at PagerDuty, which is a public company. Jukka, welcome to the show.
Thank you, Sramana. Thank you for having me here and hosting this roundtable. I think it's wonderful how you're supporting entrepreneurs with 1Mby1M, and I'm glad to be sharing my experiences today with your audience.
Fantastic. Jukka, we're going to tap into your expertise to learn more about exit strategy, which is, I'm sure everybody at some point of their entrepreneurial journey actually has to think this through. We just sold the company in 1Mby1M. One of our companies just got acquired. So we're going to be writing about that shortly. And also, one of our companies just announced a $4 million Series A this week. So Maureen can share that announcement as well. So there's a lot going on right now. As you probably know, that the biggest success story out of 1Mby1M, Freshworks, went public last week at a $10 billion plus valuation, and that's took about 11 years to get to that milestone, but it's a major milestone. So we've had a lot of action lately. So Jukka, I want to ask you first to kind of set some context about, I know you're a veteran in the corp dev world, and also a bit about PagerDuty so that I can put all that in context in my follow-on pursuit of the topic of exit strategy from the buy side.
Sounds great. So as you said, I'm currently SVP of Strategy and Corporate Development at PagerDuty. PagerDuty is a software as a service company. We provide what we call the operations cloud for modern enterprise that helps companies run their operations in the digital always-on world. My team and I lead corporate strategy, strategic planning, corporate development, and M&A. Previously, I've had similar leadership roles over the past 20 plus years in multiple VC-backed companies, as well as in large software companies such as Symantec, and before that at McKinsey, where I helped clients with their growth strategies and M&A. And I've had, over the past 20 plus years, experience from both sides of the table, buy side and sell side. On the buy side, I've been in tens of M&A deals ranging from less than 1 million to over $1 billion. And on the sell side, I've sold startups and VC-backed companies to both a strategic buyer and to a private equity buyer, which is a financial buyer. And the experience across both the buy side and the sell side gives me kind of a 360-degree view of M&A, as I believe it's really important to understand the motivations of both the buyer and the seller, and how do you align interests and make it successful for all stakeholders. If you're on the sell side, it's important to understand how the buyers look at this, what they're going through. And on the other hand, if you're on the buy side, it's important to understand the seller's journey. And also, I also think it's important to understand and have empathy for what the seller goes through, as often the emotional aspects are underappreciated. And I know how much it's very much an emotional decision for entrepreneurs and management teams, especially in small private companies.
So let's start with kind of a logic of how do you think about acquisitions, what to acquire and why?
It really starts from the strategy. We think about what is our vision, what are our objectives, where do we want to grow, what gaps do we have in our portfolio, where do we want to expand. So it starts with the markets, the categories, and the themes that are strategically important. We prioritize those and look at where does M&A fit, where could M&A add value. We often also think about this from the perspective of buy, whether we build something organically in R&D, or whether we build something organically in R&D, or whether we buy. So we consider whether to organically fill those gaps and expand, or whether it's better to acquire. Once we've defined the focus areas for M&A, then it's really about identifying and focusing on the specific companies that could be targets. We map out the landscape, identify potential targets, evaluate and prioritize them for consideration, and then cultivate and build relationships with them to get to know them, and then further evaluate the mutual fit and interests between our companies. And I want to highlight that this is usually a proactive, systematic process driven by strategic direction and strategic needs. Usually it's not opportunistic where we just react to inbound interest from some company that is for sale or from an investment banker. We do review those, we get a lot of those also, but most of the time it's not reactive to a brand new company that we didn't already know. Usually we already know the company and have had some engagement with them. Now, I think it's also important to highlight different types of acquisitions. When you're considering selling your company, it's good to understand which type of acquisition it would be from the buyer's perspective. So I'll briefly just highlight these 4 different types of acquisitions. One is what I would call a new product line or a new product SKU, which helps the buyer expand to a new market or new category, and they can plan for significant revenue growth. The second type is what I would call a technology and talent tuck-in to an existing product line, where the acquisition helps accelerate the roadmap and increase competitiveness, even if it may not be directly monetized as a new product. The third type is then consolidation in an existing market to acquire customer base, gain market share, and drive efficiencies. And the last type, the fourth type, is an acqui-hire, where the technology doesn't get directly used, it may be thrown away, and it primarily just adds valuable talent for the acquirer. So when you're on the sell side, it's also valuable for you to understand how is the buyer thinking about how you fit into these types of what type you would fit in.
Let me take some of the things you said and double click down on a few of the points. First point I would like to explore is build versus buy. Can you step us through a little bit of the logic of how you determine the answer to whether a company should build or buy? Is there a dollar amount that drives that decision, or is there a dollar logic that drives that decision? Is the time to market logic that drives that decision? What is the framework of that decision making?
Yeah, there are multiple aspects to it. One is considering time to market. So big factor there is thinking about how important it is to get to the market quickly. How much time do we have? When would we like to have a presence in this market, or a new product, or new technology, or new capability? And then considering how much time would it take organically for us to develop those capabilities, launch and ramp up. And the time to market is not just product launch, but also how much time would it take to gain revenue in that area. So it's both the launch as well as how quickly then you would gain revenue. I think another important factor is related to that is what would it look like from a revenue growth standpoint. So you can compare buy versus build in terms of what type of revenue profile would you have in both scenario. And then it's the level of investment. So what type of investment would it take organically versus through an acquisition. I think another important factor is also feasibility in terms of sometimes the areas that we may be looking at may be very close to our existing capabilities, and then the feasibility is higher, and it's easier to do that by just extending what we're doing today. Whereas in some cases, it may be a different area where we don't have either the capabilities or the domain expertise, and then acquisition may be more valuable from that perspective.
So in a sense, almost like a feature versus product decision, right? A feature can be easily extended into, and a product takes a more judicious look at, requires a more judicious look at what can be done internally, how quickly, how with what investment?
Yeah, it's really I would think about it as a multi-part rubric, if you like, in terms of thinking about, is this a new product? Is it just an extension to what we're doing today? Do we have the technology and the capabilities and skills or not? Do we have the time needed to build? And then what would it look like from a revenue and financial perspective between these options?
So you haven't mentioned anything about valuation in this matrix of decision making. What role does valuation play in whether an acquisition happens or not?
Yeah, so at the end of the day, economics have to make sense for all the stakeholders for the deal to happen. And usually this takes multiple rounds of negotiations to see if we can find common ground or not. And making it work gets more difficult when the target has raised a lot of money from institutional investors, and especially if the target has already a high valuation from the last funding round. And currently, valuations and multiples on ARR and revenues are high from a historical perspective, especially with late stage companies that have done large fundraisers. And it makes acquisitions really difficult at this time. Unless the company is struggling, investors are expecting high returns on their investment, which then raises the bar for acquisitions from a valuation perspective. And on the other hand, if a company is struggling, it may not be an attractive target then for a strategic buyer. Right. And at the end of the day, the higher the valuation, the higher the bar for conviction from the acquirer's perspective. So you need to have a very compelling must-have type of strategic rationale and compelling synergies that justify that valuation. And even then it may not get done. Now, I would add that from a founder, entrepreneur, and management team perspective, you should not just look at the upfront valuation, which you would call the nominal valuation. For founders, there are at least two parts to consider for your total economics. Number one is that usually the buyer can issue significant additional equity, such as RSUs or stock options for retention purposes. And that can add significantly to the overall economics for the founder. And point number two is that sometimes a portion of the deal or even all of the deal is paid with stock of the acquirer. And if you believe in the stock price appreciation potential, that can add significant long-term upside. And that's actually, when you consider these 2 points, that's where the economics may diverge between the founders and if you have institutional investors. As the founders get the retention equity and participate in the long-term appreciation, whereas investors don't. So the bottom line is that the more money you raise, the higher valuation you take from investors, the higher the bar is for an acquisition to work out. But obviously, large funding rounds can also help you generate very large outcomes, but it definitely raises the bar for the deal to work out.
Yeah. I'm a big believer in bootstrapping to exit. Startups with an interesting strategic product that achieves product market fit with no funding or a small amount of capital. There are companies that do capital efficient, fundraising strategies. Can have very successful outcomes for all stakeholders. And I think what you're saying about the current environment, we're in a very frothy environment. The valuations are very high. Unicorns are being minted left, right, and center. Almost every other day there are new unicorns coming. There almost are over 1,000 unicorns in the market at the moment. Now, with those kinds of valuations, exits are very difficult to happen. Private exits are very difficult to happen. You better be doing something so hot that somebody is willing to pay, $1 billion plus valuation to acquire you, and that those kinds of acquisitions don't happen that often. So, as far as I'm concerned, I think that if you have what it takes to go for that kind of a, IPO exit, you can go raise lots of money, but if you think that you need an exit at some point into a strategic buyer, it's actually a better strategy to control your capital infusion. Would you like to comment on that, Jukka?
Yeah, absolutely. And I'll give you a case example. We
Great.
acquired Rundeck last year for about $100 million plus additional equity retention. And they had been very capital efficient. They had raised only a few $1,000,000. And compared to the amount of capital raised, they had achieved a lot, both in terms of ARR and customer adoption and product and technology. And it's partly because they use an open source model to cost efficiently fuel their customer adoption and go to market. They were smart about outsourcing and offshoring and overall running a scrappy, lean organization.
Yeah.
This capital efficiency and the lack of large fundraising made it easier to make the economics work for all the stakeholders, and it really enabled attractive returns for the founders, for the management team, plus also their investors. If you can bootstrap, it gives you more control, flexibility, and freedom in how to exit and when to exit. The more fundraising you have and the higher your post-money valuation, the more constraints you will need to deal with. I'd also note that while we're using the word exit, the acquirer doesn't want you to think about the acquisition as an exit. From the buyer's perspective, usually the expectation is that you'll stay on, highly motivated to continue scaling and accelerating, and the smart acquirers usually make this attractive and give you attractive economics to stay on. So instead of an exit, I would think about it more as a new path to take things forward as part of a larger platform.
Yeah, absolutely. Very good point. All the stock that you're going to get in the acquiring company and the retention bonus or retention options, all of that, RSUs, options, all of those are part of the acquisition deal. So your compensation is a factor of all of those and not just the stated exit price. How do you access acqui-hires? Do you have a case study that we can discuss?
Yeah, I'll talk about that. I would note that first off, we don't usually proactively look for acqui-hires. We're open to considering those. We've evaluated multiple times. I've done one acqui-hire deal, but I would say it was more of an exception. Recall that we start from the strategy, where to grow, how to expand our business, how to fill gaps in our portfolio, and how to move the needle. Acqui-hires don't usually move the needle in terms of the business impact and the incremental value. So we don't prioritize those, but we can consider opportunistically. I would say that if you can bring not just talent, but also valuable technology that accelerates the buyer's roadmap and brings concrete product value to customers, that's much more valuable than just talent, and hence the valuations in a technology plus talent deal can be significantly higher than in a plain acqui-hire. I would say it's rare that the talent alone is valuable enough to justify an acqui-hire, especially given the hassle, the amount of work needed, and the complexity of doing an acqui-hire. Exceptions do happen. If you've raised a lot of capital, it can make acqui-hires even more difficult to make work. If you bootstrap or have a very small amount of capital raised, it gets a little bit easier. Again, exceptions happen, but usually the acquisition value and the economics for entrepreneurs aren't significant, especially upfront in a plain acqui-hire. And often these deals are structured such that you have to stay on for multiple years to realize the value.
So the previous example that we discussed was a $100 million acquisition that you made that had a few $1,000,000 of fundraise. What kind of valuation do you use for acqui-hires?
It really depends on the nature of the acqui-hire, as it's very specific to the strategic importance. It's specific to the domain, the technology domain. It's specific to the level of the talent that you would be acquiring in in an acqui-hire. If I give you an example, if you're in an area, let's say there's some highly specialized AI machine learning talent that you can bring that fits exactly the buyer's needs and would help them significantly accelerate their progress. It's very different situation than if it's something that is closer to just somebody hiring new engineering talent. So there's a wide range between those. I would say that in the latter case, the economics tend to be more like what you would call a hiring situation, hiring type of economics, where the upfront value is not significant. In the first situation, then it can be in the millions of dollars, and we would often look at that on a per engineer basis. But it really specific to the domain and how critical it is and how well it fits what we would be looking for.
Now, when you're looking at a new product acquisition, let's say the company has decided that you don't want to do an internal build, you want to acquire a product that's already in the market. How do you assess valuation, and what are the economics of such deals? Can you double click down into that scenario a bit more? And if you have an example, it would be great if you talk about it.
Yeah, it depends on the nature, the type of the M&A deal. As I mentioned, there are at least these 4 types with, if it brings a new product, a new revenue stream that you can take to market, or if it's just technology and talent for an existing product line, or if it's consolidation, or if it's an acqui-hire. When we looked at Rundeck as an example, a case example from last year, we looked at that given that they already had a product that had meaningful customer adoption, and we had an opportunity to scale that business up through our go-to-market and our broader platform. We especially looked at that from the annual recurring revenue, ARR and revenue perspective, and looked at what type of revenue growth we would expect, what type of investments we would need to add. So we looked at both revenue multiples, ARR multiples, as well as when often we do things such as create a discounted cash flow type of model to look at the long-term view of the business and look at what would be the net present value to you if you acquire and make it part of your business. So it's really a combination of looking at revenues, revenue growth, investments needed, and then often also comparing it to other companies. It may be comparing it to other private companies. It may be comparing it to other acquisitions to look at how would this transaction compare to what is being done in the marketplace. Now, if it's more of a technology and talent tuck-in, then we tend to look at more of the how much would it accelerate our roadmap, how much is that worth to us, what would this look like compared to an organic build if we did something R&D, and especially if it's earlier stage technology and talent or acqui-hire, then we often also look at what would that mean on a per engineer or per FTE basis, and look at how would that compare to the market benchmarks.
And any range on like revenue multiples in each case?
Yes, the revenue multiples have evolved significantly over the past, call it, few years as the market has continued to have what you could call frothy valuations, as you said earlier. The valuations, I would say that the reality is that the valuations ranges very large. There's very wide range of valuations. Whether you look at those on a ARR or next 12-month revenue basis, there's wide range. Now, it also I'll give you given the spread of a range, I think important to look at some kind of factors that might help you dial in that range and where you might kind of be. Obviously, it's helpful if you can compare yourself to other companies and look at, how would you compare to other deals that have been done recently in your area, and look at, would you be in the same ballpark, lower, higher, or why? If you're a bigger company, you might get compared to public companies. Usually, if there's been a liquidity discount, and you would be, given your smaller scale, you'd be trading lower than what public companies would be trading at. But sometimes in the private market, recently in the very last 1 to 2 years, sometimes in the private markets, people have gotten even higher valuations than what's been happening in the public markets. But I think those are some of the things that you can at least consider to dial in the range, and try to find comparable examples either in the public markets and in the M&A comparables or private financing, VC funding comparables, and look at then how do you compare to those, and kind of start kind of dialing in the range. I would say that again, it depends very heavily on your growth rate, number one. So typically, the higher your growth rate, the higher the valuation, as well as then capital efficiency, how strong your business model is, as well as how strategic you would be for the acquirer. But really, valuations can be all over the place based on those factors. So we try to kind of dial it in case by case, as opposed to kind of just having a simple kind of rule of thumb.
So in the industry, one of the best practices is to only hire products that can be sold through your existing channel. Is that the principle that you follow? Are there exceptions to that principle? Would you buy a product company that doesn't completely align with your channel, for which you're going to have to, introduce a new kind of go-to-market strategy?
Yeah, I think it's important to look at go-to-market, and I would say that we don't look at something that would kind of just only squarely fit our existing buyer, our existing go-to-market. If it sometimes there's actually value in being able to expand to new buyers, new personas, and expand that market reach and coverage. And if I just use what I mentioned, Rundeck as an example, Rundeck had a couple of interesting attributes. One was that they, in addition to development teams and DevOps teams, they had strong adoption in IT operations teams. And that was interesting for us in terms of being able to serve that persona with a very attractive product offering. They also had an open source model where you can use the open source community to get bottom-up adoption. And while we have a freemium model, we haven't had an open source go-to-market model. But that was actually interesting add-on to our go-to-market model, so that we can harness the open source community and tap into that community and work with that community, and then help kind of progress open source adopters through the funnel from free to paid users of the product. So I would say, if there's something that actually adds value to the buyer in terms of ways how they can expand their market coverage, it can actually be valuable. Obviously, from a synergy standpoint, you need to look at how quickly you can add value to the target in terms of growing their revenues and accelerating their growth rate. So we'll look at that specifically, but I would say definitely acquirers can be open to, especially
planning the channel,
new buyers or new type of go-to-market approaches.
Wonderful. Jukka, I know you have to leave, so I should let you go. Thank you for coming today. It was a wonderful discussion, and I look forward to keeping in touch. We'll talk again later.
Absolutely. Thank you, Ramani. It was great speaking with you.
Bye-bye. Take care.
Bye.